lot of people wondering why we saw so many price target increases when we have free cash flow burn going up, not down.
Okay, so I think for the year they shed $3 billion in free cash flow, and then what they repeated in the commentary that they're going to burn that same amount in 19, and then you're going to start seeing improvements beginning in 20. What should have happened for most models is that revenue estimates went up when they announced the price increase. Although this is all still a guess, we assume that the price increase is going to stick. We think it will based on a variety of data points, but we don't know. Neither does the company. If those price increases do stick and they don't have dramatically elevated churn, then yes, you'll have accelerating revenue growth as you go through the balance of the year, and price increases likely beget operating margin expansion. So that's one of those great momentum inflection points. You're going to have it on Netflix this year. Revenue growth acceleration, margin expansion, and if sub ads are up year over year, if they keep adding more subs this year than they did last year, like they have the last 7 years, we think the shares will elevate, will go higher.
Where's the red line for churn in the next quarter or two? What number starts to sound dangerous?
Well, the problem is that the company doesn't disclose it, so we're going to have to rely on our own survey work, and we're going to have to see what the numbers are as the company reports them. We've seen about a percentage increase in churn through the last 3 price increases each time, and then it mellows or moderates after that. So that's kind of what we're expecting. I think if the company were to disclose it, my guess is that they're running in the U.S. churn somewhere around 3.5%. We don't know that for a fact. But anyway, our survey work has shown kind of a percentage point near-term blip up in churn during price increases.
Always interesting, Mark, to hear the discussion around competition, which Reed Hastings, to his credit, calls out by name in his letter to shareholders. Who's the biggest threat? Is it really Fortnite?
Well, that's what Reed says. Look, I think the more accurate way to think about competition is for these kind of streaming services. You've got to think about Hulu, Amazon, and then you've got 3 new competitors coming online this year. Probably 3: Disney, Disney Plus, AT&T, Time Warner, and then you'll have the Apple offering maybe later this year. I think those are going to be really kind of the bigger competitive threats. It is a large opportunity, and Netflix's advantage is, look, they spend more on content than just about anybody. We think the cash content spend this year is going to be on the order of $15 billion. There are very few companies that can afford to do that. I mean, a handful. I mean, maybe less than a handful that can economically afford to do that. So I think Netflix, as people move towards these individual bundles, they get rid of the big bundle and they go to these a la carte services. I think Netflix is almost certainly going to be one. The question is what other people add to that bundle. And then Netflix's advantage is if we leave the U.S., in most international markets, there is no other real competition to Netflix. That's what our survey work shows. And that's the Netflix story, by the way. Sub ads are starting to slow down now in the U.S. this year. It's international subs that are still accelerating, and this company is now 60% outside the U.S. Every year, it's going to increasingly become more and more global.
But, Mark, there are analysts who are a bit less sanguine than you are who point to that international growth and the lack of or less profitability. I think, I'm looking at one report here that assumes that international business will have 3 times the number of subscribers as domestic by 2026, but revenue per user will be 25% lower with lower margins. What does that do to your valuation over time?
It's an issue. So, David, it's an unknown how profitable international markets can be. I think market sentiment is that international markets can't be as profitable as the U.S. I think that market sentiment is wrong. It's a hard thing to prove. We've seen some international markets, the oldest ones, the UK, Canada, we think those have scaled just like the U.S. did over time. And if you think about it, what drives profitability in these markets is the cost of content and the cost of marketing. And if the international markets are less competitive than the U.S., that's our assumption, but we're sticking with it. If that's true, then international markets could actually be more profitable than the U.S. So over time, that mix shift could actually be beneficial. And look, increasingly, the content is sourced globally. It's produced globally, by the way, where production costs are lower. So there's another argument there for why the internationalization of Netflix actually causes margins to rise more quickly over time.
Sure, but I mean, per capita income in some of these countries, such as India, is far below those of some of the others you cited. I don't know the ability of the average person there to be able to pay $13 a month.
Yeah. No, you're right. In some markets, that's certainly going to be the case. The advantage that Netflix has is, they are generating content. The biggest costs are content creation and marketing. That content creation, you're just getting more subs, and some of them may be at lower price points, but you're scaling those production costs over a larger and larger customer base. I mean, there are inherent scale advantages to having more subscribers viewing the same content, because the content that they're producing does carry globally.